Normally, corporate gravity dictates that massive companies grow slowly. I mean, you don't just manifest an entirely new Fortune 500 company out of thin air in 90 days.
Right, that just doesn't happen.
Exactly. But today we are looking at NVIDIA's Q1 2027 numbers, and, the laws of financial physics are officially broken. Adding $13.5 billion in sequential revenue at this stage of maturity isn't just an earnings beat. It's a signal that the underlying mechanics of the global economy are, shifting in real time. Yeah,
we aren't just looking at a quarterly update here. We are looking at, honestly, a $1 trillion blueprint for the next decade of computing.
$1 trillion. It's just hard to even wrap your head around.
It really is. The numbers coming out of this May 20th transcript are staggering, but what's truly compelling is the architectural shift behind them. It's the transition from renting cores to, buying intelligence.
Which is exactly why we're here. Welcome to this Talk Tickers deep dive, where our mission is to strip away all the noise. We're parsing the data, the Wall Street implications, and the heavy engineering that makes all this possible to give you the actionable bottom line. We want to figure out where this massive reallocation of capital is heading.
And we're going to keep it punchy and data forward, translating the jargon so you can actually use this information.
So let's start with the absolute scale of these results. In Q1 of fiscal 2027, total revenue hit $82 billion.
Wow.
Right? That is up 85% year over year. But the metric that actually broke my brain is that sequential jump. It's up 20% from the immediately preceding quarter.
Which is wild for a hardware company.
That's exactly my point. I have to push back immediately because hardware is supposed to be cyclical, right? You build the data center, you populate it with servers, and then you just wait.
You wait to depreciate them.
Yeah. So how are they sustaining a 20% sequential growth rate at an $82 billion baseline? Out of that, data center revenue alone was $75 billion.
It comes down to the fundamental nature of what they're selling now. Historically, you're right. A company builds a data center and depreciates it over 5 years. But what CFO Colette Kress and CEO Jensen Huang outlined is that customers are no longer buying components to upgrade existing data centers.
Okay, so what are they doing?
They're building entirely new entities called AI factories. And the demand for the output of those factories, which is intelligence, basically measured in tokens, is currently far exceeding the global supply of compute.
So the token is the new widget.
Exactly. The sequential growth reflects NVIDIA's supply chain simply catching up to a backlog that, frankly, stretches years into the future. They're just fulfilling orders as fast as physics allows.
Which brings us to the profitability, because you would think operating at this breakneck pace, trying to satisfy essentially infinite demand, would crush your margins.
Oh, absolutely. Usually it would.
Right. You'd be paying massive premiums for expedited shipping overtime at the fabs, raw materials. And yet, they reported a GAAP gross margin of 74.9%.
Yeah.
On hardware. I mean, that feels like a software margin.
That is a software margin. There's no other way to put it. And it reveals the true nature of NVIDIA's moat. If they were just stamping out silicon wafers, their margins would eventually compress to the 40 or 50% range as competitors enter the market.
Because it's a commodity at that point.
Right. But a 74.9% margin indicates immense pricing power derived from an integrated ecosystem. They're selling the GPU, the CPU, the networking switches, the optical transceivers, and the CDA software stack as a single unified nervous system.
So you aren't just buying chips in a box?
No. When you buy a Blackwell GB300 rack, you aren't negotiating the price of the chips. You are paying for the guaranteed uptime and the immediate time to first token.
Time to first token. I love that metric. Let's talk about the cash that margin generates, because this is where the balance of power in the tech industry actually shifts. For you listening, we're talking about free cash flow here, which I want to translate.
Go for it.
Free cash flow isn't just paper profit. It's the pure, cold, hard cash the company generated after paying to keep the lights on. After paying for all the R&D, all the salaries, the capital expenditures, they generated $49 billion in pure free cash flow in Q1 alone.
Which is up from $35 billion in Q4.
Right. Generating nearly $50 billion in free cash in 90 days gives a single company the economic leverage of a nation state.
It's an unprecedented war chest, honestly. Yeah. And it allows them to manipulate the physical supply chain to their advantage. When you have $49 billion in fresh cash coming in every quarter, you can do things that competitors simply cannot do.
Like what?
Well, we saw this in the transcript where Colette Kress mentioned they increased their total supply commitments, meaning inventory and prepaid purchase commitments.
Right.
That number is now up to $145 billion.
$145 billion in prepayments.
Yeah.
That is a brilliant connection to make, because a competitor might have, a great chip design on paper, but if NVIDIA has already handed TSMC and the memory manufacturers $145 billion in prepayments to lock down all the advanced packaging capacity for the next 3 years.
Its paper design doesn't matter.
Exactly. You physically cannot get it manufactured. They bought the factory.
Right. The cash flow creates a physical moat. They are monopolizing the bottleneck.
Mm-hmm.
And the primary driver absorbing all this capacity is the Blackwell architecture, specifically the GB300 and BL72 systems.
Which Kress noted that frontier model builders and hyperscalers have already deployed by the hundreds of thousands.
Yeah, it is the fastest product ramp in the company's entire history.
So I want to dig into the physics of that ramp.
Yeah.
Why is everyone ripping out their existing systems to put Blackwell in? What is the mechanical advantage that justifies burning tens of billions of dollars in CapEx right now?
It comes down to token generation economics. Through full stack innovations, NVIDIA drove a 2.7x increase in throughput. And crucially, a 60% reduction in the cost per token on the GB300 compared to the state-of-the-art just 6 months ago.
6 months ago? That is insane.
It is. In the AI economy, the token is the fundamental unit of value. It's the product. If your factory can produce the exact same product at a 60% discount to your competitor's factory, you have a definitive existential advantage.
A 60% reduction in cost per token is wild. But this is where the nature of the demand is shifting, and I want to spend some significant time here. We aren't just talking about chatbots answering trivia questions anymore.
No, not at all.
Jensen Huang dedicated a massive portion of this call to something he called agentic AI. He described a transition from one-shot inference to reasoning, and now to agentic workflows.
This is frankly the most crucial thematic shift for investors and technologists to grasp right now. One-shot inference is reactive.
Like typing into a prompt box.
Exactly. You prompt the model, it predicts the next word, it gives you an answer, and it stops computing. So you have a linear, highly predictable workload. But an agentic AI is proactive and recursive. It has a goal, it breaks that goal into subtasks, it reasons through them, and crucially, it uses tools.
Okay, let's make this tangible for the listener. If I ask a one-shot model to write a Python script, it writes it and stops. And if it's wrong, I have to figure that out myself.
Right.
But if I ask an agentic AI to build a web scraper, it writes the script, spins up a virtual environment, runs the script, sees an error code, reads that error code, searches the internet for the solution, rewrites its own code, tests it again, and only returns the final working product to me.
Exactly. And think about what that means for compute demand. That single request from you didn't just generate one string of text.
Right.
It generated dozens of background queries, constant memory reads and writes, and continuous interaction with external tools like compilers and web browsers. A single user prompt might spin off 100 subagents, consuming massive amounts of inference compute in the background without the user ever even seeing it.
So the compute per user request is multiplying exponentially.
Exactly, which explains why these hyperscalers need hundreds of thousands of Blackwells.
Ah.
But here is the massive curveball from the transcript.
Hit me.
If agents are using tools like opening browsers, running compilers, managing databases, that is highly sequential logistical work.
And GPUs are terrible at that.
Right. GPUs are designed for massive parallel processing, like calculating 1 billion probabilities at once. They aren't designed to click buttons on a web browser.
Which leads us to the biggest strategic bombshell of the earnings call. NVIDIA is aggressively invading the CPU market.
Yes.
With their custom ARM-based chip called Vera. Jensen explicitly stated that Vera opens a brand new $200 billion total addressable market for the company.
$200 billion?
Yeah.
It's massive.
I just have to pause on this because NVIDIA's entire identity, their entire dominance, is built on the GPU, the graphics processing unit.
Right. That's their DNA.
The CPU market, the central processing unit, has been a complete bloodbath between Intel and AMD for 40 years. It's the by-86 architecture monopoly. Are they seriously attempting to consume the legacy CPU market just to facilitate these AI agents?
They aren't just attempting it. They are already doing it at scale.
Wow.
Yeah. They have visibility into nearly $20 billion in total standalone CPU revenue this year alone. And the reasoning is rooted in the architecture of these new agentic systems. Jensen used a very specific analogy.
Oh, the harness analogy.
Yes. He said an AI agent has a harness. Think of the harnesses as the general contractor. The general contractor handles the schedule, talks to the client, orders the materials, and manages the memory state. That is sequential work that runs on a CPU.
And the GPU is the specialized crew that the contractor calls in when they need to pour the foundation or do the heavy parallel computational lifting.
Exactly. But traditional legacy CPUs, the ones built by the incumbents, were designed for cloud virtualization. They were designed with many isolated cores, so AWS or Azure could rent them out to thousands of different small businesses at the exact same time.
So the old metric was dollars per core.
Right. But an AI agent doesn't care about renting an isolated core. An AI agent is a massive unified workload that wants the work done as fast as possible across the entire system.
So the legacy by 86 architecture is actually a bottleneck for agentic AI.
Precisely. The overhead of managing all those tiny isolated cores gets in the way of orchestration. So NVIDIA built Vera specifically to act as the ultimate harness for AI agents. According to the transcript, Vera delivers up to 1.5 times faster performance per core, 2x the performance per watt, and 4x the density per rack compared to traditional by 86 alternative.
Performance per watt and density per rack, those are the two metrics that literally dictate data center economics today.
They are everything.
Because power is finite. Real estate is finite. If Vera gives you 4 times the density, you can pack 4 times the orchestration power into the same concrete building.
And this ties back to the margin discussion we were having earlier. Vera is paired with our next generation GPU, Rubin, in a system called Vera Rubin. But they are also selling Vera standalone.
Really? Where else are they putting it?
They are using it in their networking gear. They're using it for confidential computing. By controlling the CPU, they control the entire data pathway.
Oh, that makes sense.
Right. They dictate how memory is accessed. They dictate how the network switch writes the data. The general contractor and the specialized crew now work for the same company, speaking the exact same language.
That is a staggering expansion of their competitive footprint. I mean, $20 billion in CPU revenue right out of the gate is a nightmare scenario for legacy chip makers.
It really is.
But let's look at who is actually buying all of this hardware, because NVIDIA changed how they report their revenue segments this quarter. They sliced up the data center revenue into 2 distinct submarkets, and I think this reveals a lot about the macroeconomic landscape.
It does. They broke data center down into hyperscale and a new segment they call ACI. Hyperscale revenue was $38 billion, which is about 50% of the data center total.
And that's your classic massive public cloud providers, right?
Exactly. The company spending tens of billions to build the foundational infrastructure.
The ones that everyone assumes will eventually stop spending once their data centers are built. That's always the persistent bear case for NVIDIA, that their revenue is highly concentrated among 4 massive customers, and when they tap out, music stops.
Right. But the second category, ACIE, entirely neutralizes that bear case. ACI stands for AI Clouds, Industrial, and Enterprise. This segment brought in $37 billion this quarter and grew 31% sequentially.
So it's almost exactly the same size as the hyperscale business now. So even if the hyperscalers pull back, there is an equally massive, rapidly growing secondary market absorbing the supply. What is the composition of this ACIE segment?
It is highly fragmented and deeply integrated into the real economy. It includes AI-native specialized cloud providers building infrastructure from the ground up explicitly for AI. It includes enterprise on-premise data centers for 250,000 global companies who want to keep their proprietary data in-house.
Makes sense.
It includes industrial data centers sitting on factory floors.
Yeah.
And most importantly, it includes sovereign AI.
We need to do a deep dive into sovereign AI right now, because this is where technology intersects with global geopolitics. Explain the mechanism here. Why are nation states suddenly buying data center infrastructure like they are stockpiling crude oil?
Because compute has become a foundational strategic resource.
Wow.
Sovereign AI is the realization that a nation must own and control its own artificial intelligence capabilities to protect its culture, its security, and its economic future.
Okay, give me an example.
If you are France or Japan or India, and your entire future economy relies on AI agents to run your logistics, your healthcare, and your power grids, you cannot rely on a cloud server sitting in a data center in Virginia.
Right. It's an unacceptable national security risk, because if a foreign government decides to cut off your access to that cloud, your entire economy halts.
Exactly. But it's also about cultural and intellectual sovereignty. If a sovereign nation relies on a foundational model trained entirely on American data, with American cultural biases and American regulatory guardrails, that model will not accurately reflect or serve the local population.
I never thought about that.
Yeah, countries are realizing they need to train models on their own indigenous data in their own languages, adhering to their own laws.
And to do that, you need massive local compute. You need an AI factory on your own soil. Colette Kress noted that sovereign revenue increased more than 80% year over year. NVIDIA's infrastructure is now deployed across nearly 40 countries, representing $50 trillion in global GDP.
This is why the ACIE segment is so crucial for NVIDIA's valuation. Think about it. Selling to AWS is a tough negotiation.
Right. AWS has massive leverage and their own custom silicon teams.
Exactly. But selling to a sovereign nation or a mid-sized enterprise or a regional hospital network, they don't have an army of silicon engineers to piece together a custom data center. They need a turnkey solution.
Jensen pointed this out explicitly on the call. He called their architecture the most rentable. Because NVIDIA provides the full stack, the GPUs, the Vera CPUs, the Spectrum-X networking, the InfiniBand switches, and the entire CUDA software library, it's incredibly easy for a sovereign entity to stand it up and operate it.
The complexity of building a 100,000 GPU cluster is just mind-boggling. The thermal dynamics alone requires supercomputing expertise. If you buy disparate parts from different vendors, the integration nightmare will delay your time to first token by years.
And NVIDIA guarantees that if you buy their full architecture, it will work on day one.
Yep. For a sovereign nation trying to catch up in the AI race, that guarantee is worth any premium.
Okay, so the demand curve is supported by hyperscalers transitioning to agentic AI and a massive fragmented market of enterprises and sovereign nations building local AI factories. That explains the current quarter perfectly. But let's look at the horizon. Let's move to management guidance, because this is where the transcript gets almost surreal.
It really does. For Q2, they guided total revenue at $91 billion. Plus or minus 2%. So the sequential growth engine is continuing unabated. But as you said, the real story is further out.
Right. What did they say about the long term?
Colette Kress stated they have full confidence in the $1 trillion in Blackwell and Rubin revenue they foresee from 2025 through calendar 2027.
A $1 trillion revenue pipeline for 2 generations of architecture over roughly 3 years.
Unbelievable.
I want to break down what $1 trillion of data center revenue actually looks like in the physical world, because it's hard to visualize. We are talking about hundreds of gigawatts of new power generation required.
Yeah.
We are talking about retrofitting the global power grid, securing land rights, and laying thousands of miles of fiber optic cable just to feed data to these machines.
It is an infrastructure build out on the scale of the interstate highway system, condensed into a 3-year window.
That's a great analogy.
And when you look at that $145 billion in supply commitments we discussed earlier, you see how NVIDIA is translating that $1 trillion visibility into physical reality. They are literally absorbing the world's advanced manufacturing capacity to ensure they can deliver on those purchase orders.
But let's play devil's advocate here. Analysts have modeled this $1 trillion hyperscaler CapEx cycle. During the Q&A, Ben Reitzes from Milius Research asked a really brilliant question.
I figured out one. Yeah.
He noted this massive CapEx projection and asked Jensen point blank, can NVIDIA grow faster than hyperscaler CapEx? Meaning, if the hyperscalers are capping out their budgets, how does NVIDIA keep growing?
And Jensen didn't hesitate at all. He said, first of all, we should be growing faster than hyperscale CapEx. And his reasoning was multifaceted. First, compute equals revenue for hyperscalers now.
Expand on that.
In the old software as a service model, compute was a cost center. You minimize server use to maximize profit. But in the generative AI model, compute is the product.
Right.
The more compute you deploy, the more tokens you can generate and sell. If hyperscalers stop spending on CapEx, their revenue growth stops instantly.
The correlation is literally 1-to-1.
Exactly. But Jensen's second point goes back to that ACIE segment we just talked about.
The sovereign and enterprise stuff.
Right. Hyperscaler CapEx is only half the picture. The sovereign AI, the enterprise data centers, the industrial digital twins, that spending is not captured in traditional hyperscaler CapEx models. NVIDIA is capturing a massive unmodeled market that its competitors simply cannot reach because they lack the integrated software stack to make it usable for non-experts.
Let's talk about how management is signaling their confidence in this $1 trillion pipeline, because words are cheap, right? But capital allocation is binding. They announced an $80 billion share repurchase program.
And that $80 billion is in addition to the $39 billion remaining on their current plan.
Wait, so they have board authorization to buy back nearly $120 billion of their own stock.
Yeah. Kress noted they plan to return roughly 50% of their free cash flow to shareholders this year.
This is a fascinating capital allocation strategy. Usually, a massive buyback signals that a company has run out of high growth ideas, right?
Sure, historically.
Like, they can't find anywhere internally to invest the cash that will generate a high return. So they just buy their own stock to engineer earnings per share growth. Is that what's happening here?
No, and that's what makes this so unique. They are executing this historic buyback while simultaneously funding the most aggressive, expensive R&D roadmap in the history of semiconductors.
The one-year cadence.
Right. They are moving to a one-year architectural cadence. Hopper to Blackwell to Rubin, back to back to back. The R&D required to design a new supercomputer architecture every 12 months is astronomical.
So they are fully funding an ultra-aggressive R&D pipeline. They are prepaying TSMC $145 billion to lock down the supply chain, and they still have $80 billion left over to buy back stock.
It's the ultimate display of financial dominance.
Yeah.
And, they hiked the dividend by 2,400%.
Oh, yeah. There was actually a revealing moment of unscripted reality during the call regarding the dividend. Colette Kress, reading the prepared remarks, announced the quarterly dividend was increasing from 1 cent to 20 cents per share.
Which is already a massive hike.
Right. But then Jensen interrupts the start of the Q&A.
Oh, right. He gets on the microphone and corrects his own CFO, saying they're actually increasing it to 25 cents. He even joked, I think, that extra 5 cents would mean a lot to the large shareholders.
Yeah, it's a funny moment, but it underscores a level of financial abundance that is almost casual. While they are laughing about an extra 5 cents per share, which equates to billions of dollars, competitors are fighting for survival.
Definitely.
Let's delve into that competitive landscape, because the Q&A section had some incredibly technical discussions about threats to NVIDIA's dominance. Tim Arcuri from UBS brought up the threat of custom merchant silicon, specifically focusing on a technology called LPX.
This is a critical technical nuance. We need to understand the physics of memory to understand why NVIDIA isn't panicking about custom silicon.
Okay, let's break it down.
Arcuri was asking about chips designed for very narrow, specific AI inference tasks. Let's call them ASICs, application-specific integrated circuits. He highlighted fast instance or LPX architectures, which rely on SRAM.
Okay, let's break down SRAM versus HBM, because this is the battleground. NVIDIA uses HBM, high bandwidth memory, in its massive GPUs. Why would a competitor use SRAM instead?
SRAM stands for Static Random Access Memory. Its defining characteristic is ultra-low latency. It is incredibly fast.
Faster than HBM.
Yes, if you are running a service where instantaneous token generation is the only metric that matters, like a high-frequency trading algorithm or a real-time voice translation app, and SRAM-based chip can spit out tokens faster than an HBM-based GPU.
So it's a specialized tool, it's a Formula One car, it goes incredibly fast in a very specific scenario.
Exactly. But Jensen dismantled the long-term threat of SRAM by explaining the architectural trade-off. SRAM is fast, but it has terrible density. You cannot fit very much of it on a chip.
Meaning it can't hold a lot of data at once.
Right, which means a SRAM-based chip has very low overall throughput. It can only hold small models, and crucially, its context processing ability is severely crippled.
Context processing. This brings us back to agentic AI.
Yes, exactly.
Context is the working memory of the AI. Like if I ask an agent to debug a massive software repository, it needs to hold all 1 million lines of code in its working memory at the same time to understand how a change in file A affects file B.
Precisely. That requires massive memory capacity. HBM provides that massive capacity with high bandwidth, even if the absolute latency is slightly higher than SRAM. As the world moves toward agentic workloads, the context windows are exploding.
So we are going from 8,000 tokens of context to 1 million to potentially infinite context windows.
Right. And a SRAM chip physically cannot hold that much context. It would just choke.
So it's a Formula One car, but agentic AI requires a freight train that can haul 1 million lines of code at high speed.
That's a perfect way to look at it. Jensen concluded that LPX and SRAM accelerators will likely remain a niche product, capturing maybe less than 20% of the market for specific low-latency tasks.
So the brute force and massive memory pool of a Blackwell or Rubin system is actually more economically viable for generalized AI than a highly tuned custom chip.
And Jensen emphasized this point. He said Grace Blackwell and Vera Rubin support the entire life cycle of AI. They handle data processing, pre-training, post-training, reinforcement learning, and massive context inference.
It does everything.
Right. In a data center, utilization is everything. If you buy a custom SRAM chip, it can only do one thing. If demand for that one thing drops, the chip sits idle, burning money.
But if you buy a Blackwell rack, you can use it to train a model on Monday, run inference on Tuesday, and process database queries on Wednesday. The utilization rate stays near 100%. That's the economic argument that kills custom silicon.
Exactly. And this dominance in inference was confirmed by another critical piece of news from the call. CJ Muse asked about their market share in inference going into 2026. Historically, the bear argument has been, NVIDIA owns training, but when models are finished, cheaper chips will take over the inference market.
But Jensen shut that down completely. He pointed to the explosion of frontier model companies, Cursor, Perplexity, Reflection, all scaling on NVIDIA hardware. But the real headline was Anthropic.
Yes. Anthropic, the makers of those Claude models, is one of the top 3 AI labs in the world. Jensen noted that NVIDIA's coverage of Anthropic was largely zero until recently. They were using competing hardware.
Oh, wow.
But this year, NVIDIA added Anthropic as a major partner, aggressively expanding their compute capacity across AWS, Azure, and CoreWeave.
Taking a flagship customer from zero to massive scale in the inference market is a clear signal that the custom silicon narrative is failing in practice. The top labs want the flexibility and raw power of CUDA.
Jensen added that the upcoming Vera Rubin architecture will be even more dominant, stating that every single frontier model company is jumping on it from the get-go.
Okay, we've talked about the massive demand, but we have to address the geopolitical elephant in the room.
China.
Right. There has been endless speculation about U.S. export controls, what chips are allowed to be sold, and how much revenue NVIDIA is losing. Colette Kress addressed this head-on in the prepared remarks, and it was a stark reality check.
It was. Despite the booming $82 billion top line, Kress stated clearly that while the U.S. government has approved licenses for the H200 chip to be shipped to China-based customers, NVIDIA has yet to generate any revenue from it.
Zero revenue from China data center compute in Q1. Zero. And she added that they are entirely uncertain whether any actual imports will be permitted into the country by regulators. Consequently, they are not including any China data center compute revenue in their future outlook.
This is a profound data point. The $91 billion Q2 guidance, the $1 trillion pipeline, all of that is modeled with zero expectation of revenue from one of the largest technology markets on the planet.
It underscores the sheer, unbridled velocity of demand in the U.S., Europe, the Middle East, and allied nations. The fact that they are supply-constrained and hitting historic growth metrics without accessing the Chinese market speaks volumes about the global appetite for AI infrastructure.
But it also signals a permanent bifurcation of the global tech stack. I mean, if China cannot import NVIDIA hardware, they are forced to develop their own silicon and their own software ecosystem. Over the next decade, we could see 2 entirely incompatible AI infrastructures dominating different hemispheres. That is the long-term geopolitical risk, yes. But in the near to medium term, NVIDIA's primary challenge is simply building enough systems to satisfy the non-restricted world. And this brings us to a massive structural advantage that is often overshadowed by the GPUs.
You're talking about the networking layer.
Yes.
Let's dive into networking, because you cannot build an AI factory just by dumping 100,000 GPUs in a warehouse. If they can't talk to each other in real time, they're useless.
In a massive AI cluster, the network is the computer. If you have 100,000 GPUs training a single model, the workload is distributed across all of them. They are constantly sharing partial calculations with each other. This is called east-west traffic.
Okay.
If there is a microsecond of delay or a dropped data packet in that network, the entire cluster halts and waits for the data to be retransmitted.
That's called a network bottleneck, right? And it destroys your GPU utilization rate. You're paying for a supercomputer that is sitting idle, waiting for an Ethernet cable to catch up.
Exactly. And the Q1 results show NVIDIA is dominating this layer to prevent those bottlenecks. Data center networking revenue alone was $15 billion. It nearly tripled year over year.
A $15 billion quarterly run rate just for networking gear. That is the size of a massive legacy networking company bolted onto a silicon giant.
Colette highlighted 2 specific technologies here. First, InfiniBand, which is a highly spiralized, ultra-low latency networking standard used in supercomputers. Their InfiniBand business grew more than 4x year over year, driven by their next-generation XDR technology.
Now, InfiniBand is the gold standard for lossless networking, but it's expensive and complex to run, isn't it?
Which is why the second technology is so disruptive, Spectrum-X. This is their end-to-end Ethernet platform, purposefully designed for AI. Standard Ethernet is lossy. It drops packets, which is fine for streaming Netflix, but fatal for AI training.
Right.
Spectrum-X brings lossless InfiniBand-like performance to standard Ethernet infrastructure. Kress noted that Spectrum-X is now larger than all other Ethernet network peers combined in the AI space.
Because they design the network switch, the optical transceivers, the GPU, and the CPU, they can guarantee that a data packet flows from the memory of one GPU across a massive warehouse into the memory of another GPU without ever hitting a traffic jam. This is Jensen's concept of extreme co-design.
And it creates a nearly insurmountable barrier to entry. If a competitor somehow builds a GPU that is 10% faster than Blackwell, it doesn't matter. If that competitor doesn't also build a lossless integrated networking fabric, their GPU will spend half its time waiting for data.
So customers buy the entire AI factory from NVIDIA because it's the only way to guarantee end-to-end performance. Let's talk about the next generation of that factory, because the cadence of innovation here is terrifying for competitors. We are still marveling at the Blackwell ramp, but Joshua Buchalter from TD Cowen asked about the upcoming Vera Rubin architecture.
Rubin is the silicon architecture that follows Blackwell. Buchalter noted that Blackwell was the fastest ramp in history and asked if Rubin, being a completely new architecture, would face integration hurdles and ramp more slowly.
A very logical question. Usually a major architectural shift causes friction. Yields are low, software needs tweaking, customers take time to evaluate it.
But Kress's answer was supreme confidence. She confirmed Vera Rubin launches in the second half of this year, starting in Q3, and she stated they already have the demand planned. They already have the purchase orders.
Wow.
Yeah, almost all major customers are ready to deploy it immediately. She predicted the Q4 and Q1 ramp for Rubin will be very big.
Customers are signing purchase orders for tens of billions of dollars of hardware before the chips are even in mass production. And to understand why, we have to look at the performance leap Jensen promised. Vera Rubin isn't just an incremental upgrade.
By integrating 7 purpose-built chips across 5 accelerated racks, Vera Rubin is projected to deliver up to 35x higher inference throughput compared to Blackwell.
35 times higher throughput. Let's analyze the economics of that. If you are Microsoft or Google and you upgrade a data center from Blackwell to Rubin, you can process 35 times more user queries on the same physical footprint using roughly the same power envelope.
It fundamentally alters your gross margins. It drops your token generation cost through the floor, which means upgrading isn't optional. It's an economic imperative.
Because if your competitor installs Rubin and you are still running legacy hardware, they can underprice you on API calls by an order of magnitude and still make a profit while you bleed cash.
It forces a continuous, relentless upgrade cycle. The hyperscalers are trapped in an arms race, and NVIDIA is the sole arms dealer.
But the battlefield isn't just the cloud anymore. As we get near the end of our analysis, I want to pivot to a segment that Jensen highlighted in his closing remarks: physical AI.
This is where AI escapes the data center and enters the real world. Jensen called it the next wave. He noted that the $100 trillion global industry, manufacturing, logistics, heavy industry, automotive has largely been untouched by the generative AI revolution because they operate in the physical world of atoms, not just bits.
Right. You can't run a robotic arm on a factory floor from a cloud server in another state. The latency would cause catastrophic failures.
Exactly. Physical AI requires local compute. It requires edge data centers inside the factory. Jensen stated that physical AI exceeded $9 billion in revenue over the last 12 months. This includes embedded systems in PCs, workstations, robotics, and cars.
They highlighted a major partnership with Uber aiming to power a robotaxi fleet across 30 cities and 4 continents by 2028. But the robotics angle is even broader. They are providing the underlying compute for industrial robots, surgical robots, and humanoid platforms.
And the competitive advantage here is software continuity. NVIDIA's Omniverse platform allows a manufacturer to build a digital twin of their factory. They simulate the robots in a physically accurate virtual environment, train the AI agent in that simulation using massive data center GPUs, and then deploy that exact same software model down to a small embedded NVIDIA chip inside the physical robot.
It's the CTA ecosystem extending from the largest supercomputer on Earth down to a medical instrument. If a developer learns to build AI on NVIDIA, they use the same tools everywhere. The switching costs are infinite.
We've covered an immense amount of ground here, and it all leads to a highly specific, opinionated verdict on these results.
Let's deliver the actionable bottom line. If you are navigating this market, trying to parse the noise from the signal, here is what this deep dive tells you. NVIDIA is no longer a semiconductor component supplier. They have successfully transitioned into the foundational platform provider for a new industrial revolution.
Their moat is not just silicon. It is an integrated ecosystem of GPUs, Vera CPUs, Spectrum-X networking, and CUDA software that dictates the economics of the global AI build-out.
The actionable signal for those holding the stock is clear. The $80 billion buyback and massive dividend hike literally pay you to wait as the company scales into its trillion-dollar pipeline. They are throwing off $49 billion in free cash flow, aggressively returning it to shareholders, while simultaneously outspending every competitor on the planet in R&D to lock in the next generation of architecture.
And if you are analyzing the broader landscape or considering entry, the crucial takeaway is to look past the legacy GPU narrative. The upside surprises. The growth vectors that are not fully priced into the market are their aggressive invasion of the $200 billion CPU market with Vera, their dominance in capturing the fragmented sovereign AI and enterprise sectors, and the nascent explosion of physical AI at the edge. The $20 billion standalone CPU visibility this year is a beachhead in a market they intend to dominate.
They are operating with a level of visibility and control over the physical supply chain that effectively neutralizes near-term competitive threats. The physics of memory, the demands of agentic AI, and the necessity of lossless networking all point toward integrated rack-scale solutions, which is precisely what Vera Rubin delivers.
It's a masterclass in platform economics. We've stripped away the noise, translated the technical architecture, and quantified the financial scale of what is arguably the most consequential corporate transition of our lifetime.
As we wrap up, there is one final paradigm shift embedded in these sources that warrants your independent thought. For decades, the entire software industry was built on the economic metric of dollars per core. You rented server capacity by the hour, and software was relatively compute light.
But Jensen Huang stated that NVIDIA is betting its entire future on a tokens per dollar economy. You are no longer renting raw machines. You are buying pure, instantaneous, agentic digital intelligence.
The question for you to mull over is this. How will this fundamental shift from renting server space to buying proactive digital intelligence change the software you use, the companies you invest in, and the very nature of the work you do every single day?
It's definitely something to think about.
The infrastructure is being laid right now. The tokens are flowing. We'll be here to track exactly where they go next. Until next time.